Hi, this is Chris Oosthuizen from 52 Investments, and today I want to show you how we knew that gold was going to do what gold just did in 2025. The purpose of this presentation is to show you what we do at 52 Investments and why you would want to become one of our clients. Before we jump into it, let me just give you some background. I have just finished the 15th year of the track record that I have as an investment advisor. And I'm going to be sharing with you the results that I've had over the years. And the reason I want to do this is to show you that there's consistency in what I've done over the years for my clients. But more importantly, I want those who are retired to listen carefully because I've got a strategy that is specifically targeted at retired people. So if you are already retired or you are approaching retirement, you really want to listen up to this because we've got a strategy that is close to no risk and has had phenomenal returns. And these returns that we've had has blessed so many people and helping them have peace of mind so that they can enjoy their retirement while we do the work for them. I'm not going to hide it. I'm a believer in Jesus Christ, and I am filled with the Holy Spirit. The credit for the results that I will be sharing with you today cannot be given to anyone else except for our Creator Yahweh and the Holy Spirit, who has step by step guided me in order to position my clients the way that I have over the last 15 years. So listen carefully if you're retired. And if you want to know how we can manage your money better than what it is currently doing, I will first be showing you the results of what I had before I opened up 52 Investments. This was 2011 to 2014. You'll see on this table here that my client's money was invested in a mixture of different types of equities during that period with a maximum exposure of 75% in equity. My client's returns for that 4-year period was 19.06%. Had they not been retired clients and they would have had 100% of their money invested in equity only, their returns would have been about 22%. The S&P 500 during that exact same period gave us a return of 13.6%. The MSCI World gave us 11.1%, and the MSCI Emerging Markets would have given us minus 0.91%. So if we look at these returns that our clients got, they were net of fees. The competition, however, is before deducting any fees whatsoever. So it gives you a good indication of what a return could look like net of fees. Because people always want to argue and say, well, what are you charging me? Well, in our case, it's not been relevant because the returns that our clients have gotten were net of fees and is a good benchmark. Remember that past performance is not indicative of future results. I have to say this according to law, and we know that it's true, but you are able to see a trend and capacity of a person. You are able to see, does somebody know what they are doing by looking at their track record? And it's for this reason that I'm going to give you an exhaustive list of our returns because I want you to see the trend and I want you to think if this is what you would want when you are retired. So let's look at the results of our clients' returns once 52 Investments launched. In its first year in 2015, which was its first full calendar year, 52 Investments actually started in 2014. So 2015 was the full first year that I'm able to show you these results. You'll see that in that first year, our equity type was global, specifically developed markets. That would be your USA, Canada, Britain, Australia, etc. The exposure in percentage was 70% in equity, and 52 Investments return for that period was 7.87%. Once again, net of fees. Was that client not retired and they wanted all their money in equity? Their return would have been 11.05%. The S&P 500, on the other hand, gave you a negative return of 0.73%, MSCI World minus 0.32, and MSCI Emerging Markets giving us a minus 14.6%. And you'll see in a moment why I'm showing you each one of these categories, because you'd think, well, why did you not just leave off emerging markets? It's not so relevant. Well, there was a time when they gave us a good return, and we were in them during that year. So take a look. 2016, we put some money in emerging markets, but only 30%. We were very concerned about what was going on globally. And by the end of this presentation, you will understand why we were so concerned with what was going on in global markets and why we are still concerned, which is the reason we ended up being in gold, which is why we just got the massive return that we just got. So at 30% equity exposure in emerging markets and the rest of our clients' money being in bonds, cash, low risk investments, our clients got a return that year of 7.24% net of fees. Had it been an equity only portion, would have been 7.11%. S&P 500 that year gave you 9.5%, MSCI World 8%, and emerging markets being 11.6%. Obviously, emerging markets would have outperformed us because we had a smaller percentage in there, but our clients' equity exposure during that year was kept safe and was not in other markets that, as you'll see soon, did not do well thereafter. The following year, emerging markets, same percentage, our return was 12.4%. You'll see that emerging markets blew the lid off that year at 37%. And that's the reason our clients got such good growth. Look at the following year. And that's the reason why we were concerned. Yes, S&P 500 gave you 19.5% the previous year, but the following year, they had big losses. And these are not the losses that we wanted. But guess what? We anticipated this. And I say we because it's the Holy Spirit and I guiding me on what it is that I need to do and where I need to position my clients' retired funds. 2018, we had 0% in equity. It's the first and only time in my entire career that I had none of my clients' money in equity because I was concerned about everything. That year, our clients were sitting in cash and bonds and other low-risk investments, netting a return of 6.5%. The rest of the markets did shockingly. Now I'm first going to show you what the growth was cumulative up until that point. And the reason I'm doing that is because after this, I put my clients' money into gold, and I want to keep that separate from this. And at the end, we'll add it all together as well. But up until this point, I want to show you a trend. So have a look at this. So up until that point in time, 5-2 Investments clients' net return was 34%. This is a retired client. This is somebody who's 70, 80, some even 90 years old, drawing an income somewhere between 4 and 10%, depending on their age. And they have to ensure that the capital keeps growing despite them drawing this income. 34% versus the S&P 500 giving you a return of 22%. That's a significant difference. MSCI World giving you around about the same as the S&P 500, and the MSCI Emerging Markets actually catching up, giving you all of them similar returns. If we now look at the annualized returns, you would see that 5-2 Investments gave their clients 8.5% per year, where the S&P 500, MSCI World, and MSCI Emerging Markets would have given you an average of about 5%. Now that becomes problematic when you are drawing an income of more than that, which many people do. Sure, you start off with an income of 4, maybe 4.5% when you're younger, but as you get older, you need to increase that to 6%, 7%, some people even sitting at 8 and 10%. When you reach 95 and 100 years old, you don't have another 50 years to go, and you can increase that percentage so that you can enjoy the money that you worked for your entire young career and that you can enjoy it in your old age. So if you are drawing an income of 8%, your capital is going to be depleted. at a really quick rate. And so small percentages make massive differences when you are on retirement age. And that is why being conservative, which I am by nature, is important. And that's the reason why people trusted me from my early 20s. I was an investment advisor in my early 20s. I was one of the only guys my age that I ever saw around at presentations and meeting other people in the industry. And at the age of 25, I started building a big book of retired clients. At the age of 30, I was dealing 90% plus with only retired people. That's what I've done ever since. And they've trusted me because I have a conservative nature. Sure, it's nice having guys that are full of the get-go spirit and will do dangerous and exciting things. It's nice watching it on some videos and have a laugh at guys having epic fails. But I'm not one of them. And my nature fits in perfectly with retired people because I am always skeptical and concerned and on the lookout how I can keep clients' money safe. And you're going to see that now. You'll see that if you had compounded these returns. Now, why does compound make a difference? If you take the return of 2015, the year thereafter, the growth would have been on 2015's end dollar amount. And so as you compound this, or should I say lose when you have negative years, it messes with your long-term return. And you'll see it. When you look at the MSCI emerging markets return here, you'll remember that prior the return was the same. But because they had a massive loss in the first year, they never had time to catch up and recover from it. And so being conservative by nature, ensuring that you never lose money becomes vitally important when you're in retirement age and you are trying to protect your capital. And let me show you. So 5-2 Investments had a return of 38% compounded, where the S&P 500 and MSCI World remained at 21-22% averaged. That is nearly double the return. Why? Just because we were able not to have negative years. And I'm going to show you this as we go on. If you had $1 million at retirement age, after that first 4 years, you'd have had a net capital amount of 1.385 million being our client, 1.2 million being the S&P 500. And that is despite drawdowns, because if you had in 2018, when it was negative by 6.5%, and you had drawn an income on that negative return, you would have had to sell more units or more of your shares in order to get the same dollar amount as a monthly income that you need to live off. And that's why our strategy that I will explain a little bit later in this presentation becomes so vitally important to protecting your capital and giving your equity component the time it needs to grow so that your capital over the long run is able to keep up with inflation. And that word inflation is a big one. If you forget about it, you're going to see shortly why inflation can be one of the biggest killers that there is out there. You'll see that the difference there is between $170,000 and $260,000 just by investing your money wisely. That's a 4-year period. So let's carry on with 2019. So in 2019, we put our clients' money into gold, but with a small percentage of 25%, which I'll get to in a moment. That year, our client's return was 15.6%. S&P 500, MSCI World, and even the MSCI emerging markets all beat us, but you'll see that we caught up. The following year, same story. We had another good return of 13.8%. And once more, the S&P 500, MSCI World, and even MSCI emerging markets all beat us. But I want you to keep in mind that if you take these returns that they have, this is at 100% equity exposure. So to be fair, you can't compare that to a retired client because a retired client can never have all of their money in equity because they need to draw on their capital. And if markets are down 6%, sometimes 20%, you have to sell more shares to get that same income. So it never works out doing it that way. You have to have some money somewhere in low risk so that you can draw on it on a monthly basis. But let's just get back to the point. So if you had to take that 16% or even 18% averages and you were to multiply it by a lower percentage, like the 60% that we had in gold, you'll see that we outperformed them, and it's before fees. Their fees have not been deducted yet. You still have to deduct all your trading fees. And even if you've got an advisor, your advisor fees off of that. Even if it's an ETF and it's a low cost, you still have to deduct those fees, which on ours, it's already net of fees. So the following year, 21, you'll see that because of the growth of the previous year, the percentage in gold actually went up to 65%. It's not because we changed the allocation, it's just because it performed well. But that year, gold did not do well, only gave us a mere 2% return, and the S&P 500 hit it out of the park. So did the MSCI World, but emerging markets did bad. As we go on, we'll see the following year, once more, we remained stable. We didn't make any massive gains, in fact, no gains, but we also did not lose you money. You'll see the trend that I'm going to point out to you soon. But the S&P 500 wiped out the returns of the entire previous year, essentially. Because if you take in mind, the client had to draw an income, that income would have made the difference between the gain of the previous year and the loss of the following year. MSCI World and emerging markets, both of them did negative, nearly 20% returns. Then the following year, we did 19% return. What a great return. The S&P 500 did well as well. So did the MSCI World, and emerging markets had an average return. Then the following year, once more, we were positive. No negative. Once more, S&P 500 beat us, MSCI World beat us, and even the MSCI emerging markets beat us. So it sounds terrible, and you'll see just now when I show you this on the graph form, you'll see why it's actually not as bad as it might look right now. Because then came 2025. And what happened in 2025? Gold did 150%. I'm talking about good profit returns, and it made up for all of it. And I'll show you in our strategy that there has been no concern because gold gave us what we needed when we needed it, and it worked out perfectly. If you add up all the returns, I want you to tell me what you pick up is the trend between this green square and the red square. The green square has got no red figures in them. Not a single year of negative returns. Do you know what negative returns does to a retired person? I do, because I have to sit with them and explain to them what that does to their portfolio. I'm the guy that is always called when somebody's already lost 20, 30, 40, 50% of their portfolio over a few years, and they don't know what to do anymore. So I'm the one always sitting in their conversations and having to do miracles that they expect of me after they've lost a lot of money. So I'm no magician. But if we listen to the voice of the Holy Spirit, we can invest our money properly. In fact, I've actually written a book about it that I'll put a link of in the description. A book that teaches you to hear the voice of the Holy Spirit so that you too, in your everyday life, can listen to the Holy Spirit so that he can guide you into all righteousness that Jesus has provided for us. So back to this. So you can try and shoot the lights out, or you could just play it safe. And by playing it safe, your net return in the long run will always be better because you will not have to make up for losses. Did you know that a negative 10% return in year one means that you have to make up 30% in the next few years just because of that negative return? Do you know why? Because of inflation and because you are drawing an income as a retired person. You see, it's different from someone who's not retired. Year one, you lose 10%, no problem. Year two, you get that return back and your money's back to where it was. But when you are retired and you lose 10% in year one and your income is 6%, you're now down 16%. And the next year inflation has gone up, you're down 20%. And then by the time the markets have recovered, another year's of income has gone off. And when you wipe your eyes out, you had to get a return of 30% just to get that 10% back. And that's why understanding how retired people have to invest their money is so vitally important. And I've been doing this for the last 15 years. And I want to share with you today how I've done this. You'll see that the total return for our clients over the last 11 years was 240%. Had you been a non-retired client and you were still pre-retirement and saving up towards retirement, that could have been a return of 324%. The S&P 500, 140%. MSCI World, similar return, and emerging markets had a shocker of the last 11 years. Remember once more, past performance is not indicative of future results. I have to stress that. You can't come to me tomorrow, say, I want to become your client, I want 240% in the next 11 years. It doesn't work like that. But I want to point out something. Do you notice that when the rest of the markets were negative, and as a client, you had to suck up that 20% loss, that 6% loss, we were able to give you your income in each one of those years. Yes, in this one, 2022, you might not have been able to keep up with it, but at least we did not lose your money in that year, where the rest of the market lost 20%. And you see, so it's all about the ride. I am a car fanatic. I've always enjoyed cars. I know a lot about cars. And you know, when it comes to cars, it's always about what ride do you want. You can have an Audi Q7, which is one of the most impressive SUVs. It can have probably one of the best all-wheel drive systems that can pull a truck with its cargo, but you're not going to take that vehicle off-road because its rims are too large and it doesn't have off-road tires that can absorb the impact of going over rocky terrain. In the same way, you will not take a Toyota Sequoia on a long road trip if you want comfort and you want to be sitting back and driving thousands of miles. Because that road noise from those tires and those big rims are not going to give you the fuel economy that you want on a long trip or the noise level that you want that a Q7 can provide. So it's all about what type of ride do you want. As a retired person, let me tell you what type of ride you want. As somebody who's managed retirement people's money for the last 15 plus years, you want a ride that has no negative returns. Because what that does to your psychology, what that does to your health is not worth it. And it's why my conservative nature has been a blessing for me to be in this industry. And through the power of the Holy Spirit, I've been able to provide my clients with peace of mind. So let's look at what active management looks like and why watching the equity component of the investment is so important. Because many advisors today do not believe that it's their job to outperform other advisors. And so what they do, and I'm sure you'll know about ETFs, it's all about trying to just cut out costs, and no one believes in active management anymore. I've just proven to you that active management makes a big difference. Take a look at this. So let's look at where we came from before we went into gold. So I want you to have the mindset. So I'm not even 40 years old at this stage, but my retired clients have already remembered what happened with gold the previous 40 years. And you'll see that gold from 1980 till 2019 had a return of just 100% in 39 years. So I'm trying to tell my retired clients who knows that gold's essentially done nothing for the last multiple decades that I want to put a huge portion of their money into gold. And I got massive resistance. So because of the resistance that I got, they forced me. And I will tell you, it's the last time that I allowed my clients to bully me, because in hindsight, I've proven to them that they should trust me. So in 2019, the 11th of June, because of the backlash that I got from my clients not wanting to go into gold, remember, the world has done well. No one is foreseeing any problems, but because the Holy Spirit can, I know that I've got to go into gold. And my clients did not want to allow me to go 60% into gold. So I ended up getting a mere 25% out of that. Then, guess what happened? We all know that COVID came. And because of COVID, gold did phenomenal. And I was able to convince my clients to put 60% of their money into gold, which is what I wanted to do originally. Unfortunately, from the time we had put it into gold until that time, gold had already gone up 27%. So they lost out on that 27%, on that additional 35%. But shortly thereafter, they climbed another 17%, and everyone's happy and there's no complaints from clients. But have a look at this. And the reason I'm explaining this to you now is because I want you to understand what is my role as an investment advisor. Because my role is not always to tell you where we need to put your money. Sometimes it's about reminding you why we've put it where we've put it, and to prevent you from pulling the plug when I've already positioned you in the right place. Have a look at this, because this was one of the biggest feats that I had to overcome in my entire career. Look at this. The following year, after that huge quick returns, gold did nothing for 3 years straight. You saw it earlier on the table that I showed you. For 3 years, gold did nothing. And the S&P 500 was flying, right? And in that period, I had clients, and this is what my clients would do. And this is what my job is. So my job is to remind you and to help you to look at things from the right perspective. Because if you put the wrong lens on and you're not looking at investments from the right angle, you are actually making a mistake in the way in which you analyze your returns, and that can be problematic. So look at this. So clients love doing this. They want to look at the highest peak they have. That's the biggest amount of money that was ever in their statement when they received the statement. And they peg that figure in their mind. And the problem is, as soon as it drops, they'll say, I've lost money. That's not accurate. You didn't lose money, because that's not where your money started off at, right? Your money started off there at July 2019. So even when it gets to the lowest point after the previous peak, you'll see that this graph is still positive. You've still made money even at the two lowest points after that. And that's the way that you have to look at your investments. And that's my job. My job is there to remind you of these things. You know why? Because people become emotional. I have fortunately been blessed where I am today, that I've learned not to become emotional about it, and I've learned to just tune into the voice of the Holy Spirit, and all I do is I listen to him. If he doesn't say anything, I don't action anything. And so what you see is, you can then look at your investments and you can say, wow, look at those peaks and look where we started off until those peaks. And we can see that each time we kept making money in the long run. And thereafter, what happened? Gold exploded this year. It absolutely exploded. Now, I'm not going to give you all the reasons why it has exploded, even though I will explain some of it in this presentation. I have to keep some of it back. Otherwise, people just go and do their own thing, and you will steal what I already know. So, we'll see here that gold did 210%. That means that your capital amount grew by 3.1 times, right? People who are not as clued up with maths often don't understand this, but 210% means 3 times, not 2 times. So if you had $1 million, you would now have had $3.1 million. So why gold? Why was I able to hold on for 6 years after going into gold and not remove my clients' money out of gold? Why? Let me show you why. The S&P 500 over the last 90 years has given a return of 203 times. That figure is astronomical. That's a multiple. So it's gone up with a multiple of 203 times. And people quote these figures often. And I'm going to show you today why these figures are not quoted accurately. And I hope that if you can stay tuned with me, and even if you're not able to stay concentrated on this presentation the whole way, and you have to listen into it in segments, or you have to listen to it step by step or multiple times, do so and try and grasp what I'm explaining to you. I've been given a gift to make the complicated simple. It's one of the reasons I don't use jargon from our financial industry to try and sound clever and impress you, because you will not be able to understand it then, and you will not be able to understand what I'm explaining to you. So I want to make it plain and simple. So 203 times is what they will tell you the S&P 500 has grown by. But once you adjust it for inflation, you'll see that the true figure is a mere 11 times. So a lot of that growth is actually not growth. It's actually just inflation, things that are expensive, prices increasing. Remember, you don't get a McDonald's hamburger for 50 cents anymore. McDonald's hamburgers have gone up in price. And so you can't see that as growth. It's not growth, because the same thing you would have bought then is a lot more expensive today. So this presentation, I've done it multiple times before. You can even see me sharing some of this info on previous presentations on YouTube. But this is so vitally important. You have to stick with me through this. So for a period of 56 years, so from 1930, when the Great Depression took place, for the next 56 years, if you remove inflation from the picture, the S&P 500 did zero. Yes, it did recover during the 1960s, but it then crashed again. And it's only until the 1980s that you would have got your money back. So what does that mean? If you had put $1 million into the S&P 500 in 1930, you would have had to wait 56 years before you got that same $1 million back in your bank account, adjusted for inflation. So obviously the amount that would have come out would have been more than $1 million, but it would have been the equivalent of what you would have bought something for in 1930. You have to remember that. There's no point in saying my money is tripled, quadrupled, but then it's worth less than what you would have bought that house for 10, 20, 30, 50 years ago, right? You have to adjust it for inflation. So once you've adjusted it for inflation, the S&P 500 has actually been a shocker of an investment. I want you to see this. The next 24 years after that, so once that 56-year period ends, if you take the 24 years directly after that, no gap in between, you'll see that the S&P 500 gave you a return of 110%. If you divide that by 24 years, that's an annualized return of 3% per annum. So you got zero, then you got 3%. So the question I've got is, what happened here? Because something happened in this point in time here. And if you're not clued up with the markets, you won't know what had happens. And the reason I'm sharing this presentation is because often in life, you've got to take a step back and you've got to look at the bigger picture. Because what happens is we get so excited in the short term, Bitcoin, cryptocurrency, our eyes are so zoomed in that we don't see the bigger picture. And when the world comes crashing down, you don't even know that it's crashing down. And the analogy that I give is, if you are on a lake busy fishing, right? And all of a sudden the dam collapses. The dam wall comes crashing down. By the time you realize that the dam wall's collapsed and your boat is being dragged down that stream, your boat is not powerful enough to get you back to the shore, and it's too late. And that is what's busy happening right now. And no one has noticed. And that's the reason why gold has jumped I'm not going to tell you why it is. So what happened that caused this abnormal growth? Because the growth that we see here has over a 16-year period given you 470% return. That's 12% per annum, right? So you've gone from 0 to 3 to 12%. How do you get that right? Because something happened. Quantitative easing, right? QE. People make it out as if it's nothing. They think that it's okay just to break rules and to think they can get away with it. There's a big problem here. Look at this on the graph. And I've never seen somebody illustrate it the way that I'm going to illustrate it to you, because the Holy Spirit pointed this out to me. Otherwise, I never would have picked this up for myself. Here you have the graph of quantitative easing. First, they printed $600 billion. They then printed another 600 billion, then 2 trillion, and then more than 3 trillion. Now let's look at that same graph. I've squished it up together because I'm going to show you another graph underneath it, and I want you to see the similarities. Here's the S&P 500 with that exact same period. Look at that. Every time they printed money, the economy was stimulated. Of course, that's what quantitative easing is there for. It's there to stimulate the economy. But you think that it's okay? It's not, because it's caused other problems. Your debt is currently skyrocketed and it is out of control, Mr. Government. You cannot do what you've done. And if you do not get out of this trap, it's probably going to be too late. So we see here that something happened in this point in time, and it's because they printed money. So the growth that happened from 2008 until now, I call it fake growth. You cannot call it growth because it's been stimulated by monopoly money. And something like this has happened before. Take a look. You remember this 24-year period where the growth was a mere 110%? Look at this. Because before it collapsed, its growth was 11% per annum. Does that figure of 11% sound vaguely familiar? Why? Because remember the 12% that we've had up until now? Why? Because it's fake growth. Because after they had that growth, the economy crashed. And the only thing that then caused that crashed economy to recover was what? Quantitative easing. You've got it. The only reason the US stock market has been fine for the last 20 years is because they started printing money. This is an astronomical problem. You have to understand this. And the growth that we have currently is fake. And my question is, what should we expect soon? Give me a reason why I should not expect the bottom of the US economy to fall out. So you'll often see this graph and they'll show you all the big crashes that the stock markets have had over years. Great Depression, Black Thursday, dot-com, global financial crisis, right? But what they don't show you is that this is inaccurate because you have to factor in inflation. Remember, inflation. I keep telling you, look at this. The two graphs, they look identical until you notice that the straight line takes a lot longer to recover. It takes an extra 3 years and 4 months longer in order for you to get your money back because of inflation. Because while that stock market on that top graph has been negative, and as time goes by, well, the price of your hamburger doesn't stay the same. The price increases. That price of your Ford F-250 crew cab doesn't stay the same. Because in the beginning, before the market crashed, that F-250 would have cost you $26,000. 16 years later, would have cost you $39,000. And that's why you have to adjust for inflation. You can't say, well, I've made my money back 13 years later, because you have not, because the thing that you are going to purchase, your purchasing power with that same money, that thing's price has gone up. And that's why it takes longer for you to get your money back. So now, going back to the adjusted for inflation graph of the S&P 500, you'll see that it's 29 years. Then you'll see that there's another gap there of 27 years. If you take it from the peaks, the highest peak. If you then take the highest peak, you'll see it's 16 years. Why is this one so short? Once more, should this not have been a depression, right? Same as the previous two depressions. There were two depressions, and those depressions take longer to recover from. But because they printed money, they cut the depression short. Yes, that was their goal, and yes, they did achieve it, but it's caused long-term problems, and I'm about to show you what that's caused. I'm now going to give you the updated data on the same presentations I've done years ago. And so you can go and watch the old presentations if you want. And I'm taking the exact same information, and I've just updated for the last few years since I've made the last presentation, so that you can see the point that I've made back then. The reason I gave my clients back then for why we went into gold, it's still valid. In fact, it's worse. Let's take a look. US government debt has continued skyrocketing. Now, you can scream Biden, you can scream Trump as much as you want. This graph is consistent through both different elections. Then you look at the interest rate. Yes, Trump tried dropping the interest rate to 0, and yes, it did climb again, and Trump is trying to drop it. But the problem is, it is too late. Look at this. The interest rate is sitting at 3.75%. But what does that mean? Okay, the reason I've shown you these two things together is because when you have debt, you've got to repay it. And you've got to repay the debt according to the interest rate, the same as your credit card, the same as your mortgage, right? So what did that look like? Now, remember, this is from my previous presentations, but I'm going to show you the updated information. Because in my previous presentation, I said, look at this. You've got $28 trillion. You got to repay it at 0.25%, which is great. It's a mere $71 billion in interest. Remember, this is money you are losing. You are paying this on top of the capital that you have to repay. But in 2022, not only did the debt go up another $3 trillion, but the interest rate skyrocketed under Biden, and it went up to 3.25%. And the problem with that is your interest alone is $1 trillion. Okay, so what happens now? Because no one is busy paying debt back. So what happens? That gets added on top of the debt that you have. So not only do you now have the problem of your debt getting out of control because you keep making more and more debt, but now the interest is not just adding small figures anymore, but massive figures. Have a look at this. This is now 14 times greater interest that's just been added to your government's debt. Look at this graph. So you've got the total amount of debt, which is $37 trillion. You've got the interest rate of 3.75, so it's even more now, despite it coming down considerably. That's $1.4 trillion, right? Can you see how it went from $1 trillion to 2-3 years later, $1.4 trillion? I don't care how much tariffs Trump brings in, it's too late for the US government right now. In 2021, $71 billion, which was 19.5 times more now than what it was then. Now, I want you to look at this. If you take that figure of $1.4 trillion and you divide it by $300,000, which is the average price of a decent family home if you're not living in luxury, you could give 4.6 million homes away for free to Americans. I want you to let that sink in, because we throw these figures out and everyone sounds clever and everyone's talking in billions and trillions and it sounds great, but we've got to quantify these figures because you've got to realize how serious this is. This is every single year. This is not over a period of 10 years. Every single year right now, if this is not going to be capped, if the interest rate is not going to come down to zero, and through some miracle, Trump is going to bring in more tariffs so that he can reduce the amount of debt that there is, this figure is only going to get worse and worse. So you're sitting at $1.4 trillion. 4.6 million homes could have been given away for free in 2025 to American citizens for free because the US government has to take that money out of their budget and pay it. That's how it works. There's no way of getting away from this. And I pointed this out 6 years ago already. I started, in fact, prior to that, I pointed it out, but 6 years ago is when I made presentations that I put on YouTube. And you can go and have a look at it where I said, this is a problem. And I said that it will only get out of control. And it has become out of control. So what is our strategy? And I want to explain to you how strategy works, because this is something that the Holy Spirit gave me multiple years ago, and my clients' money's been in it for over 10 years already, and it has worked out perfectly for retired clients. So what we do is in year one, whatever your income is, if you just retired and it's 4%, we'll only put 4% of that capital in that bracket next to year one. You'll see in a moment how it works. And I'm going to be explaining the same thing twice in two different ways because I want you to understand our formula. I want it to sink in so that you can understand this, so you can get confidence in what it is that we do. So if you're older, obviously the percentage is going to be high and the figures will be different. That's the reason why I'm working on a percentage in the beginning here, and just now I'll give you illustration in dollar terms so that it's easier to understand. So year one, we take 6%. We take that 6% and we put it aside. Then we take another 6% for the next year. We take another 6% for the next year, the next, and the next. We put enough money away for 5 years so that you can have enough income safe one side so that you can draw on that income as and when you need it. Why? So that the rest of your money can be put into equity so that it can be untouched and it's not needed to be touched, so that it can grow and there's no fear of what it does in the short term, 1 year, 2 year, even 3 or 4, 5 years. Doesn't matter what it does. It can be as volatile as it wants. It's not too important what happens. You'll notice that we also put some money aside in an emergency fund because, of course, you might need to draw some money out. You might need to buy a new vehicle. Your roof might be blown off by a hurricane. You might need to replace it. You might have flood damage and insurance is not paying out. That's what the emergency fund is there for. We put some money into there. So when you add that all up, you'll see that it adds up to 35% between year 1 to 5 and the emergency fund. And then what you do is you put the difference in long-term growth. Now, of course, if your percentage of your income is higher as you get older, there will be less money going into the growth component, but that's fine. It works out. So this portion here from between year 1 to 5 and emergency, we put this in money market bonds, low to medium equity mutual funds, low risk type of investments to medium risk type of investments. The rest of it goes into equity. The highest risk that you can get in mutual funds and stocks, that is that you're able to put the money into so that you don't have to be concerned about it in the long run. Let's look at what this looks like. In the beginning of year 1, the graph looks as it is right now. At the end of year 1, you'll notice that the money is gone out of the first box, but you'll see in year 2, 3, 4, and 5, those amounts have all gone up from 60,000 to 61,500. Why? Because you've had growth. Although it's been invested in a low risk investment, you'll still get a little bit of growth, and that amount has grown. The reason that's important is because that caters for the inflation that you're going to need, because in year 2, you need to draw a higher income. So we've catered for that, and I'll show you that in the next part of this presentation just now. Also take note that in the growth component, you'll see that that has gone up considerably. So what I'm doing here is I'm first showing you what is the investment doing in a bull market. How does the strategy work in a bull market versus a bear market? I'll show you that in a minute. So at the end of year one, this is what it looks like. Then the money's gone, the money's increased, and at the end of year one, we take that growth and we fill it up. So we transfer 61,500 back to year one, and you'll see that the growth component is now less 61,500. And that's what it looks like in a bull market. So every year, when you've had capital growth, you capitalize, you take that money, you throw it straight back. You don't use up year 1, 2, 3, 4, and 5. You don't use up all that money if you've had a positive year. You take the money straight from the growth component, you push it straight into year one. You'll see that growth has gone down and year one has gone back up. Okay, now what do you do in a bear market? In a bear market, year one, end of year one, the money in the year one is finished. Year two, it's finished, but you'll see year 3, 4, and 5 has increased, right? Because they keep growing, because money markets and bonds, they'll still give you a little bit of growth. Year 3 is gone, year 4 is gone, year 5 is gone, and then what happens? The growth component exploded because equity will, over long-term periods, always recover. Sometimes it's longer than 5 years, but this is the best way that we can play this. So you'll also see that the emergency component is there. So if you did not touch that money and you were able to not have any emergencies and draw on that, you're able to use that for year 6, which means you can give your growth component a longer period of time. So what happens then? At the end of 5 years, we now take from that $1,066,000 and we transfer $67,000 to each of those different buckets, because you've now made up, the capital has grown, and then you transfer the money back into all those, and then you'll see that the growth component has gone down accordingly. But notice that the growth component has gone up from $650,000. It's now $726,000. And also notice that you're now drawing an income with close to no risk, because this portion of year 1 to 5 has now been filled up again and there was no risk. So you gave the growth component 5 years, even up to 6 years, untouched, because you gave it that time. So it doesn't matter. But if you were to now have taken all of your money, you put it into an ETF or S&P 500 and you have to draw, every time you have a negative year, you're drawing on that negative and you got to sell more shares in order to get that money. And you don't have the luxury. Guess what? If you got 56 years of negative returns, remember on the S&P 500 graph I've shown you with the adjusted figures for inflation, what happens if it's 27 years negative? You can't do that. You've got to put some money aside and you've got to be wise with how you manage your money. Okay, now let's look at the same strategy, but we're taking the theory, I'm going to put it into practical in dollar terms for you. So you start off with $1 million. I'm using $1 million because it's an easy round figure to work with. You got $2 million, put it in there. If you've only got $100,000, put that in there. 65% goes into gold, which is your equity component. I'm showing you what we've actually done with clients' funds. And 35% goes into your income and into your emergency fund. So that's $650,000 in gold and $350,000 in your income portion. So what then happens is 6% of your money goes in for year one, right? That's $60,000, okay? The following year, because of inflation, we got to adjust that 60,000 Rand. We got to add 3% for inflation, because whatever your expenses are, your utilities, your food, it's all going to go up. And so you got to have more money that you're going to be drawing. So that's 61,800. The following year, the amount of money that you'll draw for the year will be 63,000. Goes up to 65, 67,000. The total that you've drawn over that 5-year period is not $300,000. It's $318,549 because of the additional money you would have drawn for inflation. But it's okay because it's covered by the growth of the low risk investment. So what your investment looks like 5 years later is the 350,000 would leave you with $56,275. Why is that? Because of the emergency portion. Remember the emergency portion, you put $50,000 aside for emergency, that's now gone up to $56,275. Now, the great thing about that, as I said earlier, that money you can use for another year. Yes, it won't be enough for a full year, but it's close and it helps. What happens after that? Your $650,000 has gone up to $1,066,000. You add the two together, and 5 years later, you've got $1.12 million. And that's how the strategy works. So, I want to explain to you how we fit into the market. What is our position in the market? Because I want you to understand who we are, and what we're not. Because we fit into a really niche market. We are not trying to get everyone to become our client. We've got a very specific market. There you are as a couple, there you are as an individual, and you have got an investment with Charles Schwab as an example, right? I want you to understand what and who Charles Schwab or your custodian is, because that's what these companies are called. They're called custodians. And I want you to understand the role of a custodian because it is often misunderstood. And what happens is clients put their trust in the custodian, which is not reasonable. And let me explain. A custodian is primarily an administrative investment platform, which provides no financial advice. If you are directly invested with them and you decide to cut your registered investment advisor out of the picture, which you can do, and that's fine, you have to understand that you need to instruct the custodian on where your money must be invested. They will not help you, and they cannot by law give you any advice. They cannot tell you, pick this stock, pick this mutual fund. They cannot do that. They are merely an administrative platform, right? Your money is safe with them, but it is only safe because it cannot be stolen, right? It's safe in the context of a custodian. It's not safe in the context of an investment, right? Because someone is not watching it or ensuring that it is invested properly. You have to understand that because I often hear clients telling me, no, but Fidelity is watching. Surely somebody there's watching my money. No, they are not. You have to understand that you've got to separate the custodian from where the money is being managed. And that's our role, right? If the underlying investment underperforms, it is the fault of your advisor, not the custodians. And if your investment does well, you should praise the advisor, not the custodian, because the custodian had nothing to do with it. So what often happens is these custodians have got good, reputable, they've got good standing with clients, and clients will say things like, yeah, my money's been safe with Fidelity or Charles Schwab or whichever company, but it's not them that had anything to do with the performance. And that's what I want you to understand. So where do we come into the picture? So 5-2 investments. Alternatively, you can appoint an registered investment advisor who then has the role to submit these same instructions on your behalf. Instead of you being the one who's responsible for your own investment advice and financial advice, the investment advisor representative is the one who's responsible for giving you the financial advice and who takes over the responsibility of your portfolio and ensuring that your money is in the correct place. So if he does a good job, he should be praised. And if he's negligent, he should be held liable. Many advisors take a passive approach and do not believe it is their role to make active decisions. We disagree with this, and we believe in actively managing our clients' investment portfolios. And that's why I've shown you what we do. We don't just place your money somewhere and hope it does okay and just keep charging you a fee every single year. No, we actively manage it. We also have a strategy, and we also have to make adjustments to that strategy on a yearly basis, depending on whether it's a bull or a bear market, or whether we believe it's a good time to make adjustment or not. So, where's your money being invested? So that underlying investment of yours could be in any of 7,000 mutual funds ETFs and stocks, right? So my question to you is, of course, you can manage your own investment, but do you understand mutual funds? Do you understand stocks? Sure, you can get some advice from your uncle, your father, your brother, a cousin, a nephew. That's fine. But realize one thing, and this is what I want you to understand, that you are responsible for managing your investment. And if that goes south, you are going to have a fight and an argument with that relative of yours. But doesn't matter how much you fight with them, you can never bring your money back. That is what we do. We take over that responsibility of your investment. And of course, we charge a fee for that. Of course, clients don't like paying fees, but look at our return net of fees. I have never had clients complain about the fees that we charge them. I only have prospect clients questioning me about fees. As soon as they've been with us a year, 2 or 3, I never hear them complaining about fees ever again. So what do? At 5-2 Investments, we take your money and we put it into the different mutual funds or stocks according to how we feel is perfectly positioned for that season. Remember, because it will change over time. There's something else I want you to understand, and that's our position in the stock market with relation to the rest of life. This is now not within being in an investment product with, say, Charles Schwab or Fidelity. This is now within the industry, comparing it to different industries and how you can see this. Now, this is my own personal opinion. You can't take me to court over this. I'm just giving it to you as an illustration to understand the amount of risk that you can place on these different types of investments, and I'll explain to you why I give them these different types of ratings. So in our industry, being invested into mutual funds, not stocks, mutual funds now, I believe that the risk is from 1 to 10. 1 being a money market, bonds being about a 2 or 3, and then you've got multi-asset classes, which will be somewhere between a 3 and a 6 and even an 8. And then your full equity would be an 8. And then your full equity that is only invested in one single class, say property only, or resources, or industrial, or finances, or anything like that, that's an individual class, that would be categorized as a 10, as opposed to an 8, which is a multi-equity. So still 100% of your money is an equity and an 8, but it's spread. So the risk is spread between property, resources, industrial, etc. But it's still a 1 to a 10 in risk. Now, if you are drawing an income, it would be probably between a 1 and a 6, those different components where we draw the income from. Now, stock picking, going and saying, I want to buy this stock or that stock, that I would put in a category of 20. The reason I put in a category of 20 is because when you're in a single stock, if that one company goes under or that one company underperforms, you can't compare that to a mutual fund that has got shares in 100 different companies. If one of them goes under, the other one doesn't, or if one of them performs bad in 1 year and outperforms the next year, in a mutual fund, the returns would be averaged out. And that's why I say it's in a lower risk being in mutual funds. Stock picking goes up, nothing wrong with it. I'm just wanting you to understand how these fit together in the bigger picture. I'm not saying the one is better than the other. I am for all of this. I just want you to understand where it fits into the bigger picture. Then you've got a business owner. Now, business owner falls between a 40 risk rating and a 100 risk rating. Now, I'm a business owner myself. I'm all for that risk. But if you're a business owner and you get to retirement age, you don't have the time, you don't have the energy to manage your business to ensure you can continue getting the income. If you don't have children that's there or people that are worthy enough to manage your business and ensure that it continues. Yes, the returns are way more than what there would be in the portfolios and the returns that we give our clients, but it's a different market. Hence, I said we're in a niche market. I want you to understand where we are because we manage retired clients' funds and we need to be conservative and not have much risk attached to it. I'm all for business owners, but when you reach your 60s or 70s, sometimes your 80s, some guys that can't just retire, then would be a good time to start making contact with us. Then you've got cryptocurrency, and I put cryptocurrency at 1,000 because cryptocurrency is really dangerous. You can make a lot of money. You can quote the figures to me as much as you want and say, look how many thousands of percentages it's gone up. And that is true. Can you stomach it when it's lost money? Can you stomach it when it's negative year after year? What if your money gets stolen? Because this is a reality. I know of people who've lost all of their Bitcoin because someone hacked their account. I'm not talking about an 80-year-old lady who doesn't know anything about phishing and scams. I'm talking about guys in their 20s who can even trace who's stolen their money, have lost their money, and they can't get their money back. So be very careful. It is really easy. It's an unsecured way to get some money. And you'll see I'm very cautious with the words I use there because I do not call crypto an investment. Crypto is not an investment. And as a retired person, you cannot put your money in crypto that you need to live off. If you have additional money that's over and above the portion that you are living off, then that money you can put into crypto. No problem. Go and play around, put some money into it, have fun with it. But do not put the money that you need to live off, that's allocated for drawing an income and for the capital growth portion that's supposed to make up for that income. Do not touch that portion and put it into crypto. And then lastly, there's gambling. Gambling's like literally throwing your money down the water. You'll never make money. That's literally just another form of entertainment because you can never make money with gambling. That's just a crazy. It's just to put it in there for you. So I want to end off and just remind you of our returns because you now have the picture in the back of your mind. What type of returns were that? Not only did we outperform the rest, but our returns were low risk and there were a 1 to 10 on a risk rating. So if you've enjoyed this presentation, get in touch with us. If you are close to retirement, already retired, and want to know and understand how we can do this for you individually and look at your own personal circumstances, because every single one of our clients' investments are looked at individually, we can come and sit with you in person at the convenience of your own living room, and we can discuss these things with you. Free consultation. Get in touch with us. Allow us to help you navigate these treacherous waters in these dangerous times that we live in now. You do not want to be caught out in 1930 where you put your money into the stock market just before it crashes for the next 56 years. And for that reason, you need an active investment management. And it's not even safe for you to put your money into ETFs. You've got to be very careful with where you put your money in if you're retired. Thank you for watching this. Chris Oosthuizen from 5 to Investments. Bless you.